Hello, everyone, and welcome to BFW 2401, Week 7, Single Loan Credit Risk. Now, I recommend that you watch introductory slide number 1 and number 2 before you go to this main slides. You are only responsible about those slides, which is 27 slides. And but the introductory slides number 1 and 2 will give you some background so we can proceed in the slides. So this is the part that you are actually responsible about. Now, if you allow me, let me just go and share my slides for today. So this is what we are talking about. We are talking about the part 1, which is credit risk. Now, credit risk is actually, if you look at the map of our unit, we are actually working here, single loan credit risk, which is actually week 7. Now, credit risk is actually is in week 7 and week 9, but in week 7 we talk about week 7 and week 8. So in week 7 we talk about single loan, and in week 8 we talk about the portfolio. It's actually, there is some overlapping, but this is how you can see it. Anyways, this is how can you see we are talking about credit risk, and credit risk is actually the core of lending and the core of this business of financial intermediation and commercial banking. This is the resources. I think these references are okay. I recommend that you look at the book and you check chapter 10 and chapter 11. I already brought everything that you need here, but for more explanation, it's better to look at the book. The book is very good in this area. This is the learning objective. I think most of us don't understand what are loans, what kind of loans banks give until this moment. So actually in this area, we are trying to know the importance of loans, but actually we want to divide them to business loans, housing loans, personal loans, and this is what we call in banking financial products. It's not actually the risk, but it gives you an important issue of what type of loans the bank actually are offering. Now we will go to some other important issue, which is actually the most important thing is actually the pricing. And we want to, if you look at the pricing, let me just take this arrow, it helps me. So we are talking about the pricing, which is one of the most important issues after we know the loans. And the pricing is one is part of what we call the contract. And after we select the right customer, we have to run what we call we have to maintain a type of contract, and in that contract we have to price how much we are going to charge. So this area will let us understand how to do the how to calculate the expected return and actually the contractual return for any loans. And then we will go to the measurement. Now the measurement, as I have explained, it will be based only when we want to measure a credit risk for an application. We have to go, because we need to measure that credit risk before we grant the loan. And so we do what we call credit scoring. And the credit scoring, we use the financial statements components, calculate the strength of this customer. And we have already models. We put the results in the model, and there is a benchmark. If the customer or the business firm passes that benchmark, we grant the loan. If it doesn't, we just disclaim the loans. And this is based on credit scoring, not in judgmental approach. Now we will actually discuss what would we mean by qualitative models and quantitative models, but our concentration in the credit scoring is within the quantitative models. Now, we will talk a little bit about understand the key components of credit scoring, which I already explained it on introductory slides number 1 and 2. The credit scoring, I don't want to go deep on it. All we want to know is that the way we grant the loan is based on type of credit scoring. And the credit scoring is connected to the quantitative models, okay? And then we will go to more advanced models, okay? So let me now just go to the, all this blue font is actually what we are going to cover in week 7. This will be forwarded to week 8 with, I will add this models plus the portfolio risk, and it will be covered in week 8. But these blue things is actually in week 7, and then I will give a summary. Just to introduce, loans represent 70% of Australian bank assets. It's almost 75% in Malaysia. And if you go to some other countries, you'll find it between 60 and 70, the loans, and the rest is actually investment in the market. But the bulk of the assets is actually loans, whether you are talking about housing loans, or we are talking about business loans, or we are talking about personal loans or government loans. So management of lending is, and credit risk is crucial to bank performance, because it has impacts in shareholders' value, and we understand that. So lending is an important contribution to bank profits, but if there is a lot of risk, then that profit can be dropped. So it also creates a key risk, which we call it credit risk. And we have talked about credit risk earlier in the semester in week 2. Credit risk is just the defaulting. Either you default the principal or the interest or both, or you be late in payments. That all is credit risk, and we want to try to avoid it, and starting by using this credit scoring issue and choose the right customer. So it starts with the selection process. Now, lending is crucial to the domestic and the world economy. We understand only the flow of capital from one bank to another bank, from one area to another area, is very important for the growth in the domestic and also for the world economy. Credit risk is important. Subprime was a credit risk, which is the recent financial crisis, 2008. Credit risk is an important factor in the global financial crisis. That's we have to understand. All global financial crises, whether you are talking about 2008 or Asian financial crisis 1998, was actually credit risk, and then accumulated to liquidity risk and all those issues. Lending is part of the banking book activities of financial intermediaries. We understand it's part because we have trading book, and the trading book where we don't keep the asset until maturity. We just sell it the second day or the second auction day. And this is actually what we call it trading. But the loan, when we give a loan, we keep it for a long time unless we go with this new issue called securitization. But the basic concept is if I give you a housing loan, you will stay with me for the next 20, 30 years until you pay housing, car loans, other personal loans. This is how it works. So it's part of the banking book. We have banking book and trading book. Trading book is only those assets that we trade them. Now come to the classification of loans. I have only these slides, and actually we have commercial and industrial loans, secured and unsecured commercial industrial loans, and we call it syndications. Now we have also spot loans. We can give a loan now, or we can promise to give loan in the future. We call it loan commitments. We can decline in commercial and industrial loans originated by commercial banks. There has been decline in this area. And the reason is because the borrowers of banking from the banking system is not borrowing anymore from the banking, but becomes an issuer. So the borrower is becoming an issuer. So they go and issue money market products or bond or capital market products like bonds, and they can borrow from the market. So they issue the stocks or they issue bonds and borrow the market instead of taking a housing, a huge commercial loan, a huge business loans. They just go and issue bonds. So they have been moving to the money and capital markets by corporations, and this is, you will find that when those developed when we have developed what we call financial system, that financial system will allow the borrowers who were actually bank customers to become an issuers of securities and raise money from the market. This is what we call disintermediation. Now we have, this is for the commercial and industrial loans, which can move actually through what we call disintermediation to become, they can be declined as they become, they can seek the, capital and money market. Then we have the real estate, which is actually represents 80% to 70%. And we have those real estates, which is the housing loans. It can be fixed mortgages. It can be adjustable rate mortgages, or can be mortgages can be subject to default risk when loan to value increases. And we have talked about this, and let me just talk about, we can get loans, which is fixed mortgages, fixed rate mortgages, but actually most of the loans in most countries now, part of it is fixed, which is what we call the spread. And then you have the basic lending rate. So the bank will take the basic lending rate and will add 2% or 3%. So the basic lending rate, when it moves, increases or decreases, the value of the loan, the price of the loan, which is the interest rate of that loan, can go up and down. And this is why we call it adjustable rate mortgages. So it can be like, a variable type of mortgages. Now, sometimes when the interest rate is changing, for example, and we have explained this in securitization before, when the interest rate changes and for example, I take a loan for 10%, now the loans are given for 4% or 5%. So the value is actually the loan to the value is increasing. So when you feel that your loan is actually costing you more than your assets, and it can happen because of the increase in the interest rate, then in this case, most customer will default or will just liquidate those loans, or they just give away the loan. So you take a house which is 300,000, as what happened during the financial crisis because of some type of housing bubble. Then when the prices dropped and the house that cost you $300,000 is now sold in the market for 150. So the loan is actually, which we call the value, loan to value, LVR, is actually higher. So in this case, if the loan to the value is increasing, then there is no customers usually will give up the loan, will give up the assets and let the bank take it over, because it's just cost them more what the market is offering. Now we have also consumer loans. which is personal loans, auto loans, credit cards, all of this comes under personal loans. So the main three categories is the commercial and the industrial. The biggest category is housing. The third one is consumer. Now you can also divide them to what we call revolving loans. Revolving loans, like the online, what we call facilities, overdraft. So now this one is actually like the credit cards. Credit cards, they will grant you a loan of 8,000 and you still, withdraw from that 8,000 until it finishes. You pay the statement end of the month, then you can withdraw up to 8,000 again, and you continue like this. You don't have to sign a contract every month for new 8,000. So it's revolving. Line of credit is the same thing. They will give you over withdraw, for example, up to 1 million. So you keep withdrawing that up to 1 million, and then you pay it. And then you take, again, you can withdraw up to that limit. And then you keep, paying. So if you are doing some type of business and you want to manage your liquidity, banks usually will give you this facility called line of credit. So they will give you, as I said, I think before, 1 million over your, over the, over your loan. So for example, if they are giving you, if you open the current account, checking account, current account is opened by those, business firms. And then they keep, depositing to the account and withdrawing from that account. But for example, they have problems with their suppliers, or their customers are actually late in their accounting receivables. They're sending this accounting receivable policies where they can receive their money a little bit late. They can also keep withdrawing from the bank up to 1 million, for example. And then when they receive from the receivables, they pay it back. So you have this range up to 1 million. You don't have to sign contracts. It's a revolving loan. We call it line of credit. So you can talk about line of credit. Okay. We have non-revolving loans, which means it's only one transactions, which is automobiles, personal loans. And we have another category, you can hear this, which is we can give farming loans, interbank loans, government loans, all of those names of different type of loans. But as I told you, the main three categories is actually this one, the consumer, A, B, and C. Now, as you can see, the development, actually there have been a drop in this category, which is the housing, the government loans. But as we can see in so many countries, this area has been increased. See, they increased from 47 and increased to 50, actually 52 by 2011. This is just in Australia and some other countries. So the housing loans is actually a very important drive for the economy, stimulates the economy. Most government, encourage those housing loans. And this is what we can see, they have been increasing. Other personal loans actually have been dropped significantly from 9.5 in 2000 to 5.4. So the concentration, most of the concentration is actually in this area. Now let's come to the one of the most important issue actually, which is the pricing. Now, when we talk about the pricing, when we give a loan, when you apply a loan, when you apply to the bank for a loan, they will charge you the following. They will charge you the risk-free. And we call it basic rate. And then they will check it, based on the category of your loans, whether it is housing loans or business loans, or if it is this retail loans, standard loans, they have already their premium. For example, housing loans in this country, 2%. So this is the 2%, the premium. And then when you sign the loan, you have what we call a fees. So you will have to pay fees, and you will have to pay, this is the basic rate, which is the risk-free, and the premium. This is the three component. So this K is actually, if you get $1, you will give $1 plus K. So it will be 1 plus this one. But what about the B and the R? Now, in each loan, so the bank usually will give you a loan of 1 million, but they will tell you, you have to participate in that loan. So you have to give 900,000, 10%. So actually, if they give you, if it is 1 million, they will only finance you with 100,000, finance you with 900,000. So this amount that kept in the bank, supposed to be kept in the bank from the loan, because the loan will be counted for 1 million, but they will tell you you have to participate for 10%. So you have to pay what we call compensation balance. Now the compensation balance is the amount that will stay in the bank from the amount granted to you. So this is one issue that will increase actually the cost to the customer, because I'm not taking the whole 1 million. They give me 1 million, but I'm receiving only 900,000. And they say that 100,000 is the compensation balance, which is my participation. And then also the bank will pay a reserve, because the deposits that were received and given, your loan was received from deposits. So these deposits, actually, not all the deposit was given, not all the deposit were given to the loan. Also, I'm giving to the customer the whole $1 return for his deposit. I'm using, like Malaysia, I'm using only 96 cents of each dollar. So there is a reserve, and that reserve is a cost for the bank. So the bank is incorporating the R here. So if you can see now, all of these components now, so you will take $1, you have to give $1 plus K, and the $1 plus K is actually, this is the $1 again, and this is the K. So you have to pay, as I told you, the fees, the principal rate, what we call the premium, and then that has to be decreased from the compensation balance and the reserve. So all of this actually will increase the cost for the customer. So the nominal rate, maybe they will tell you 14%, which is this plus this, but then you will have to pay fees, which is an increasing. You will have to take that to consideration where it will be increasing. Now, this is actually the nominal or the contractual rate you get. But when you collect, the bank already know, the expected rate will be only the probability of payments, and this is a new concept I want to understand. It's the probability of payments. For example, if the probability of all loans payments in Malaysia, say 98%. So you'll bet here 98%. If it is 95% in any economy or in Malaysia, then you will get only 95% of your principal as a bank and from the K. So this is actually the expected return. So the expected return is P probability of payment times 1 plus K minus 1, which is, if this is 95% and this is 14%, you can calculate it and see. Let me give you examples. This is, for example, if I'm going to calculate the contractual. This is what I want you to know, the contractual or this is the contractual. And the contractual is, I give you PR 12, basic rate, and premium is 2%. The fees is 1.25%, 0.125%, which is 12.5 basis points. The compensation balance 10% and the requirement 10%. You just use the formula, and if you use the formula, you will find the K to be 15. Remember that when they told you it's only 14%, but actually what you end paying is 15.25 if you put it to the formula and you take all those two considerations. Now, what actually you are receiving? You are receiving, if the probability of payment if 95%, now we are talking about the expected return, which is actually this formula. This is what we are talking about here. So this is actually the expected return. Now the expected return is this formula. And you can see the expected return, take into consideration the default risk, which is the probability of payments. Now, therefore, the bank need to set risk premiums. So the risk premiums is taking care of the risk of defaulting. Now, even when you, for example, when a customer comes to you, this is very important issue I want you to look at. When you let me just take this arrow. When we are talking here, you have to be careful when you price your loans. For example, a customer comes to you and he is desperate. He wants the loan in any way. So you can take from 1 to 15%. But actually, if this is the expected return, if you are looking for the expected return, this is the nominal rate. You can charge up to 15%. It's okay. You will sign. The question is, what is the best rate you can get so you can have the most expected return? So in this, according to this calculation, the K star is 8%. So there is a relation actually between the expected return on a loan and actually between the contractual loan. So in this case, if you want to increase the expected return, then in this case you have to be aware of what the pricing. So the pricing is actually very important. How much premium you have to take, because the pricing is coming here in the expected return, right? You have to understand. You have to be careful evaluating the customer and evaluating his risk, what kind of risk you are taking. You have to be aware of how much fees you charge, because if you charge more and the customer take the loan, especially if it is business loans, they may take loans that is actually what they do, what they get, the return of the project they are investing in is the return of it is less than the cost of the borrowing. And in this case, you just say you give the loan and you know that the customer will default. So calculating this, choosing the right premium, choosing the right percentage here, some other factors we cannot control, but anyway, the contractual return has to be in a way, when we calculate it, has to be in a way that actually increase the expected return. So there is actually, they are not independent. This one, contractual return, is not independent from expected return. They are related, and you have to get to a place, this what we call reverse U shape. You have to get to this area where you can actually get the best. So in this case, you charge 8, and you still can change 1, 2, 3, up to 8. 8 will give you the most expected return, because the most expected return, look at this. If you are trying to use this formula, I'm just taking the example. This is 15 1525, right? Which is the 1525 here. K 1525. If the probability of payment 95% and K is 1525, the expected return is become 29487. So actually, because you will get only 95% of your principal and 95% of your K. It's not about your K now. You are losing from your principal and from your interest. So this is the relationship I want you to understand. I want you to take care. I want you to take it to consideration when we are talking about the expected return and the contractual return and the expected return. You have also to understand the component and what are those components of the contractual and what are the components of the expected return. We know this K is actually this K. Okay. Now, when we receive loans, we receive it from two areas, the loan applications. Retail, which means those small loans, small dollar size loans. Credit card is a retail loans. TV loans, TV and household type of loans. You can buy furniture, you can buy, 1 year, anything you can, have installment for one year, any type of, appliances, furniture, so many things you can buy in those small personal loans. And we call it the small dollar size loans. We have higher costs associated with collection of information about those loans. And usually we use credit scoring. And when we use credit scoring, we usually accept or reject the loan. Who is taking the loan? We will see, like the credit card. We will see who is the person, put the information, bunch it to the system, key it to the system, and see whether it accepts or rejects the application. And they are actually standard loans rates. It has a standard loan rate usually charged, as long as the customer is, passing the what we call the benchmark. We don't have to worry about pricing. It's one price for all of those. Now, when we have a wholesale, which is the business ones, we can control. It's different than credit risk control for wholesale. So the retail, as I told you, different from the wholesale because the wholesale is huge business, and we have to take to consider to the way we evaluate it is actually differently, and we have to price it through this type of formula. We have to take to consideration all those issues, and we have to calculate the all of those issues because the M will be different and the fees will be different. All of those issues we have to take to consideration. But this one is actually, I told you, standard loan, regardless who is the customer. Now, the credit risk control, we have a wholesale. Now, to control the wholesale, if we have so many applications from businesses, the only thing we can do is we can increase the interest. So if we increase the interest rate, if we give them the first loan, for example, for 12%, if they need the second loan, it will be to 14%. Rational thinking and rational, economic, what we call rational economic man, as businesses do, they won't, if they know if the interest rate is increasing for the next loan, they will not take it. The second thing is you may also decrease the credit quantities. You say, okay, the loans we are giving, for example, we are giving loans for the working capital, we are giving loans for machines, we are giving loans for some other, type of operations, to maybe expenses and salaries, whatever, to manage the liquidity and the cash flow of the company. We are giving this line of credit. But when there is so many applications, then you can decline some of those applications or disclaim them. When you decline those ones, actually you decrease the quantities. So the way to deal with businesses is either to increase the interest rates or to decrease the quantities of loans. Now in retail, which is this one, those people don't care. If they want to go, if they want to take a loan for a car and they want to take a loan for a tour, they want to travel around, maybe go to all those countries. If there is a loan, they will take it. And later on, they want to take a loan for a small house. Then in this case, the way to do it is to control the quantities. So if he takes a loan for, he can get a credit card, he cannot get another credit card, he cannot get, you consider whether how much, credit loans for cars you can give them and whether you should have a housing loan or no. So you have to decrease the quantities because if you increase the rate, they still take. They are not aware of interest and how much you charge them as businesses, because businesses, they have sophisticated models to see this is just personal loans. So the way to deal with that is, as I said, wholesale, you take K and credit quantities. For retail, you just decrease the quantities. Now, let me go to the default models. And these default models is a credit scoring models. Now, the credit scoring models, as I told you, the way the credit scoring default risk models is based on the default, what you call the credit scoring. But we are not using it for personal loans. We are using it for what we call wholesale loans or business loans. Look at this ones. We have, this is the models. This is actually the models. Now there is some information we have to consider. We have to look to the quantitative models, and the quantitative models, they use observed borrowers characteristics. As I told you, maybe in the introductory slides, we talk about credit card. We have to take all those income, age, occupation, profession, all those issues we have to take to considerations. Dependent, whatever. But now here we are talking about companies. So we have to take the observed borrower characteristics, and usually if it is a business loan, we take this information from the balance sheet. We establish factors and their importance to explain default risk. And of course, when we take all those data about all those customers that have been with us, we are concerned about those customers who have been defaulting. So we will do some type of regression. We will take all the characteristics, which we think are the factors of defaulting, and we will, based on the regression, it will tell us what is the most important factors. Those factors, we take the balance sheet of any application, and we put the numbers of the balance sheet. And from the regressions, we will also develop what we call credit scoring or benchmarking. And according to that benchmarking, we accept or reject the loan. This is what we do. It's like the business loans. And we like the personal loans, which I show you in the introductory slides. So based on the benchmark, you improve, you improve pricing, and you improve the pricing and default and you improve the pricing, and you take, I think there is a, you improve the pricing and the default risk and calculate the reserves needs. So to make this one, to explain it, in details, We have three models. We have linear probability model, we have a logit model, we have a linear discriminant model. So as you can see, it's almost a regression. Here a regression of three factors, and I will show you. And statistically, and this model is not very sound actually. And I will show you what is the problem. But this one, we call it Altman Z. Altman Z is actually a 5-factor model. And we have to bring all this information from the balance sheet and put it there, and we have a benchmark. And I will show you 2 examples now. But also we have what we call qualitative models. So also we have to take some information. We have to take information about the borrower specific factors like reputation, leverage, collateral, volatility of earning. And we have to take into consideration the use of covenant to encourage certain borrower behavior. So this is factors actually included in granting the loans. We bring some term of conditions, and we have to take into considerations all those issues. Now, we have also to look at the economy when we give loans, and we establish our policy of granting loans. We have to look at the business cycle, boom versus recession. Our expectations should be there. Expectations. If we think there is a boom in the economy, future boom in the economy, then we expect less defaulting. But if we have a recession, we know that most businesses will not do well, and there is a probability that they will default. So default is actually highly associated with recession. And also we have to look at the level of interest rate. Higher interest rates is associated with defaulting, as I explained to you here. When the interest rate is higher, there is probability that we will default. Okay, let's go now to the first model. This is the default risk model, and we call it linear probability model. All of those actually is qualitative models. One called linear probability model, logit model, and linear. All of them are linear models. So this one is actually, we have to calculate the Z value and the Z defaulting. So we will take the all those factors. This is a regression analysis, as you can see. The problem with this Z is sometimes it can go to minus. And if it goes to minus, it has no meanings. Let me give you an example. So linear probability model, suppose that estimated linear probability model caused by financial institution to predict business loan application default probability. So we use now PD, which is probability of defaulting. And according to this model, it's a fixed model, 03x1, 002x2. This is the actually the regression. So all we have to do, so the coefficient, we don't change it. Coefficient is fixed. This coefficient, 0.3 of the regression, this coefficient is not changed. This coefficient is not changed. We just will take the financial analysis of the financial information of the applicant and try to put it in X1, X2, and X3. Please follow me carefully now. So what is it? X1 is actually debt to equity ratio. X2 is actually volatility of borrower earnings. And X3 is the profit ratio. And we have, so in this case, if we have for a particular loan application, if X1 is 0.75, X2 is 0.25, and X3 10, I just put the use the X1 here, use the values of the X's, and this regression and this formula, and then get the defaulting. So as you can see, if I multiply the coefficient by the values of X1, X2, with the variable of X1, X2, X3. So in this case, I get this is the probability of defaulting, which is actually 2.5%. So if it is 2.5%, this is what I want to, if it is 2.5%, that means probability of payment is actually 1 minus 2.5%. Which is actually 97%. Now it's up to me. If the benchmarking, I didn't mention here the benchmarking, but if I'm accepting any loans that exceed, for example, if my benchmarking in 95%, if benchmarking, which means I can accept this Z of 90 equals 95%, I will expect, I will, the loan will be approved. What if I'm very conservative and my benchmarking is 98? If it is 98, as you can see now, this loan will be rejected. So the linear probability modeling is calculating the probability of defaulting. Okay. Now the problem with this model, the probability of this model is sometimes you can get probability of defaulting of minus, which has no statistical meaning. And it could be, look, if I give you now, if the debt to equity ratio is 1, this is highly leveraged. And the profit ratio is 90, which is actually very extreme case. In this case, if you put this here and this here, you will find this minus. Minus has no meaning. Defaulting, because it doesn't have any meaning. And therefore, in this case, this model has weaknesses. And therefore, a major weakness of this model is that estimated probability can be under 0, like what we did here. This is actually under the 0. This is actually under the 0. 0 is higher than this one. Or can be above 0, above 1. So if it is above 1, now in this case, like what we did here. Here, if you take the 1 minus zero 1, you will find the probability is 1.1. There is nothing called probability of 1.1. It doesn't, there is no probability of 1.1. So this is actually, it doesn't make sense. And therefore, we have, they have developed another model called the logit model to deal with this issue. So they try to restrict. I don't know, people in statistics under this and understand what I'm talking about, but for you, you are just responsible to understand this issue. They restrict this BD to be between 0 and 1. And they developed what we call the logit model. So the logit model will make the BD between 0 and 1. So the BD will be actually, it will be, the BD will be higher than 0 and less than 1. So the BD will be higher than 0 and actually less than 1. And if this is happening, this is what the logit model tried to do. So the logit model is actually trying to restrict this PD to be between 0 and 1, so we can get rid of problems like this. And the system and the if we develop this model, then in this case, actually, the logit model will actually solve the problem of this unsound Siskel, or this unmeaningless, unmeaningful results. So this is what we do. Number 3, and there is no calculation in this, and I'm not giving you an example. I just want you to understand that the logit model is actually solving the problem of the linear probability model. Okay, we go to the next model. This is very known, which is Altman. Now, Altman is actually 5 factors. Okay, and has been developed. So actually, this is the critical value. If the value between 181 and 299, that's fine. You can actually, it's a critical area. You may consider it, you may not consider it. But if it is over 299, then accept it. So what is the X1 and the X2? Remember here, the X1 and the X2 is different. X1 here and the X2 is actually volatility, the profit, and the debt to equity here, and all this balance sheet numbers. And this is a business loan type, and this is a credit scoring for business loan. So actually, we are taking the working capital over total asset, X1, retained earning or total assets, and somebody will say, is this a worldwide model? Yes, it's a worldwide model. It has its weaknesses, but you can use it in any country based on the balance sheet numbers. This is X3, earning before interest and tax over total assets, and X4 is market value, and this is sales. So what you do now is you just calculate. For example, if I give you these values, you can calculate the values, and if you calculate the values, you find that to be 3.04. So the question is, should you accept this, approve this application? Yes, I should approve this application because it's actually more than 299. Yes, since it is. Now somebody will tell me, what if it is between 181 to 1, you can still accept, but it is a critical. You may accept it, you may not accept it. It's what we call the critical area. The critical area, you don't reject. You reject only when it is under 181. You reject only when it is under 181. If it is over 181 to 299, it's actually absorbable. It's a critical area. But under 181, this benchmarking already, this one is not going to be accepted. Over 299, of course, you will accept it as we did here. So this is actually what we call the linear discriminant model, which is based on this. This is actually the what we call the credit scoring. And this is the linear probability modeling and the linear discriminant models and the logit model. Logit model is actually solving the problem of linear probability. Now let me come to, they have weaknesses, those modeling. They have broad distinction between borrower categories. So it's just good and bad. So as I told you, in the linear probability modeling, if you put 95 or 97%, for example, the benchmark, anybody under 97 is bad. Everybody over 97 is good, which is not right, actually. You come to the Altman, Altman model, which is the Z-score of Altman. This one, you say anybody under 81 is no good. This one is critical, and the third one over 299 is good. So this is actually, this cut is you cannot, you have to have more categories, okay? So the weights. The weights, as you can see, which is the coefficients. The coefficients either in the discriminant model, see the coefficient here, 0.03, the coefficient, which is 3.2 and 0.05, which is the coefficients of those variables. They can be changed. Even when you talk about the Eltman, Eltman is saying 1.2x1, 1.4x2, 3.3x3, 0.6, and 1. So this weights is actually also another problem. The variables, we have 3 factors in the linear model, linear property modeling. Eltman, we have 5 models. We have 5 variables. We should have more, because if you are talking different contexts, different countries, different regions, different industries, different loans, the variables should be changed. And so this is one, you cannot have this free size shirt and ask everyone to wear. But it a little bit helping, but actually this is one of the weaknesses. Model ignores hard to quantify factors such as borrowers' reputations, which is all these issues, as you can see, when you take it, all these areas are ignored. All those areas, maybe the leverage is coming somewhere, but the collateral, the reputation, all of those issues, actually, specifically when we talk about reputation, all of those issues is actually ignored. There is no centralized database on defaulted business loans for proprietary or other reasons. So actually, if you want to develop this model, and you need a database. And when you need a database, you will actually develop this, what we call, you need to run regressions. And when you need to run regressions, you need to come with the X1, X2, X3, which is the coefficient. The regressions is you are looking for the default loans. So you have to have data. And now banks are not actually sharing their loans and defaulting their loans, where you can take those loans, for example, in Kuala Lumpur or in Penang or in Malaysia, for example, or in Indonesia. So it's very difficult to get every single loan and started to, there is no database actually to share all this information where you can actually come with more accurate models. So this is the weaknesses of this modeling. So they come to new models, and they come to something called the term structure deviation of credit risk. And this is single period, and mortality, and RORAC, and term structure, and option models. And this class in week 7, we will only talk about these 2 models, and I will start with the term structure. Now, the term structure is, please understand it with me so you don't get confused. See, actually, let me give you, if I give you $1 today, actually, $1, I expect to receive tomorrow as a bank, the $1 plus K. Now, if this $1 plus K, if this company is not defaulting, this K could be like the I, which is the risk-free. If I can put my money in some type of treasury notes, which they will give me a return, or I can give it a loan to a company. And if this company is AAA, top company, does not default, it should receive it with the risk-free. Then, but actually, usually the K is more than the I, because companies will default. There is always defaulting. And therefore, if this $1, 1 plus K, should actually equals, so if this is the I, should actually equals the one plus k if there is no defaulting. If k equals I, then actually the $1 should come back as $1. This is how it works, plus k. But actually, this is not the case because k, there is a defaulting. And if there is a defaulting, this k is actually more than I. And therefore, I'm going to do probability of payments. So this is the formula. And therefore, if I want to know the probability of payments now, actually it's 1 plus I over 1 plus k. This is how it works, where I can calculate dB, which means now if I look at this, if this is the k and the I, let me move this a little bit just here. And this is the defaulting. So this is the return. And this is the defaulting. Which is the probability of defaulting. Call it what we call. So defaulting, which is PD, the probability of defaulting. And the probability of defaulting can be 5%, 6%. Now, actually, I don't know, if this is 0, if this is 0 and this is, you just continue. 0 means, and this is the K, and this is maybe, and this is the I. This is the I, which is actually this I. This I, if the I is, if the risk of defaulting, this is the risk of defaulting, right? If the risk of defaulting is 0, then the return should be here in the I. But then actually the K is here because there is defaulting. And therefore, actually, this defaulting, this PD from this area to this area is actually this defaulting from this area to this area is receiving this premium from here to here. This premium from here to here. And this is why the K is higher than the I. This is the whole concept. So if the I is actually, if the K is 0, if the defaulting is 0, then I will equals I, K will equals I. But actually it's not true. And this is, so I am charging this premium, let me see if I can provide another shape. I'm receiving this premium for this defaulting. So this is actually the premium. And this is actually reflecting what we are talking about here. So 1 plus I. So if you want to calculate the probability of payments, you will calculate the probability of payments, then the probability of defaulting. Probability of defaulting is actually probability of payment -1. Probability of payment -1. This is the probability of defaulting. Where is the probability of defaulting? The probability of defaulting is actually this area from here to here. You can calculate it. If the probability of payment 95%, this should be 5%. This should be 5%. And these 5% may be, I will show you an example now how it works. But I want you to understand this issue. I try to withdraw it here. Hopefully it's understandable. I will discuss it more in the tutorial. Okay, now let's go to come here. So coming back to so the expected return is probability of payments is 1 plus K should equals 1 plus I. Now assume now we enter a new issue now called there is what we call a collateral. If we have a collateral, then the payoff will be probability of defaulting times the collateral times 1 plus K plus the probability of payment. This is the probability of payments. This is the probability of defaulting. When we have a defaulting, we have what we call a collateral. Now we entered something to the formula now, which is the collateral. Now the collateral is actually this one. So if you want to develop this is when there is no collateral. When there is a collateral, there will be a payoff receiving from the collateral, which is the asset, which is this part, and a payment, the normal payment, which is the probability of defaulting plus 1 plus I. So in this case, you can calculate if probability payment of Y. So the payoff for expected to be received from the loan is this one, which is, I told you, this one. So this is the probability of payment plus the probability of defaulting. It will give you the probability, the payoff of this loan. So now if you want to calculate if Y is more than 1, more than 0, and it should be more than 0, the required premium will be less for any 1 plus B. So actually the premium now is less because the defaulting, if there is a defaulting, you will also first take it from the collateral. And therefore, if you want to calculate the premium, which is the most important thing for us, which is K minus 1, this is the formula, 1 plus I, collateral plus probability of payment minus P times Y minus 1 plus I. So where Y and B, which is the probability of default, the collateral and the probability of payments are actually have a negative relationship, or you can call them perfectly substitute for each other, or have, you can say, negative relationship. This is the most technical thing in this part of the slides, and this part one. Okay, so having said that, I'm done with this one. So you already know how to calculate the premium. See, last time we used to calculate the pricing through, we just like what we price. We bring all the cost and we add our profit and we say this is the pricing. But now when we started to use the risk-free, we just calculate the premium based on the defaulting. And the defaulting, we can take it from the credit rating of the company. We only need to calculate the defaulting of the industry. And if the company belongs to that industry, we can use it. or we can calculate it for the company based on the on the uh, uh, on the credit rating. Now I'll give you an example. This is example for whatever. This is for 2 periods. We will not discuss it. We'll discuss later. We will discuss for 1 period. So this is the maturity, and this is the years. So we have here I of 10. We have K of 15.8 given to you. So I charge the company 5.8. The yield to maturity and T-bills is 10%. So now I can calculate the probability of payment, which is 1 plus I. I find that to be 95%. Very easy, 1 plus I over 1 plus K. So if the probability of repayment is 95, we understand the probability of defaulting is 5%. So therefore, the risk premium is K minus Y is 5.8. See, I'm charging the company 5.8, and this number is given to me. And the risk-free is 10%. If I know the probability of payment, I know for each 5% defaulting, I am charging 5.5 premium. Now assume the loan has no collateral backing. Has a collateral backing of Y0. Of course, this will drop. Now, if you have therefore, the risk premium for the loan will be less for any given default risk, probability 1 plus B. If I is 10, probability payment 95, and if the financial institution expects to collect 90% of the promised proceed of the default course, which means the premium is 90%, the collateral is 90%, then to calculate this 5.8, look, it becomes only 0.55 basis points. See the drops because of the collateral, because this is actually premium for the credit risk. So solving the premium, it's 55 basis points using this formula. Therefore, an increase in collateral will decrease the default risk, or Y is a perfect substitute for P. Or negative, when probability of payment is increasing, if you have a customer with high probability of payments, I will tell him, you don't have to give me high collateral. It's okay. Because if his probability of payment is high, then I don't need collateral. The opposite is right. If the probability of defaulting is very, very high, then in this case, I'm going to ask a high collateral from this customer. So actually, P and this sigma is actually our substitutes. Okay. Now I'm done with the mortality. I'm done with the term structure. It's the most complicated one. Here is just mortality rate, deviation, credit risk, very easy. It's similar to the process employed by insurance companies to price policies. The probability of default is estimated from past data. This is just calculated. So we have mortality, what you call marginal mortality rate 1, marginal mortality rate 2. So this is the total value. For example, if you have an issue of bonds for borrowing company, and how much they default, this bond is 20 years, how much they defaulted the first year, how much they default for the second year, and they continue like this. So if you look at this example, and this is so MMR is actually total value of grade B bond defaulting in year 1. This is the defaulting. You just divide the defaulting. This is very easy to divide the defaulting by the total issue, by the total outstanding. And you get that percentage. And you calculate for year 2, year 3, and then you draw this graph. So if it is steeper, actually, if this graph is steeper, it's riskier, which means now the defaulting in year 1 is just, how can I say this? So if it's really steeper, this one is high defaulting. If it is actually just like this, it will be less riskier. So in this case, the mortality, the defaulting in year 1 and year 2 and year 3 is less and less and less. It can be like this, or it can be like this. If it is like this, it's actually starting from year 1. This is very risky. And this is less risky. And this is why we say, if this company belongs to this industry or to the B bonds, and it's a B company, I am expecting the defaulting of it like this. And therefore, I can decide whether I should invest or not invest. This is just a measurement of the risk of those companies. And the ranking actually coming to the credit rating categories. Look in the United States, for example, they bring from Triple A, as you can see, from Triple A, E, B, B, all of those. And this is the marginal MMR. So if you can see, Triple A is 0, 0, 0, 0, no defaulting, which means the is right, actually, the credit rating 0, 0, 0 here, 0, 2, 0, 3 in year 7, and then continue. But look for this Triple C from the first day, from first year, 7.86 defaulting. And it continues here in year 3, almost 18.6. So it depends, you know that when you check this one, you MMR, which is marginal mortality, it will tell you where to invest, and you have to decide, you know, this is a measure of credit risk if you are going to actually give loans to those companies or actually to invest in the market. I'm sorry I'm giving this, it's not sorry, it's just you may notice why this Triple B 038, 14312, and here jumped to 3.7. This is because of the WorldCom collapse 2001. It's an outlier type of observation. So don't take it to consideration if it is 3.7. It's just the collapse of 2001 of WorldCom. WorldCom was here and have a lot of bonds, so there was too much defaulting from the bonds they issue when this company collapsed. So marginal mortality is just use this formula and use actually the graph. This is the summary, which we talk management, the importance of lending, and we talk about the credit scoring, and we talked about the new models. I don't want to take much of your time. I don't know how long I'll take here, but I can tell you, I'll stop here and I will thank you very much. And hopefully we will discuss more in the tutorial and then the workshop. Thank you very much. What I should say, good night or good day wherever you are. Bye-bye.